This is chapter one for Advanced Financial Management, Finance 4300. This is an introduction to the entire book. So this is we're talking. This is financial management, which is corporate finance. We're going to be talking about various aspects of corporate finance. It'll be at a much higher level than you covered it in your introductory classes. It will be very accounting intensive. So as far as the first chapter goes, key concepts and skills. Know the basic types of decisions that financial managers make. The role of the financial manager in those decisions. Know the implications of various forms of business. Know the goal of the financial manager. Understand the conflicts that can arise between owners and managers. When we're talking about a corporation, that's shareholders and managers. That's also referred to as the principal agent problem. And finally, we'll talk about the regulations that corporations face specifically. So, chapter outline 1.1 is what is corporate finance. 1.2, the corporate firm. 1.3, the importance of cash flows. That should be fairly obvious. Without cash flows, not going to survive, obviously. The goal of financial management. Agency problem and control of corporation. And then finally, regulation. So what is corporate finance? So, corporate finance addresses three questions. First, and what long-lived assets that should the firm invest? So we're talking about fixed assets or capital assets, so forth. How can a firm raise the required capital for these expenditures? Where do we go for to get this money? What's the best source? And we'll also talk about the costs of the different sources of capital. And then finally, how should short-term operating cash flows be managed? So, balance sheet model of the firm. So, the left side is the total value of assets. Just like the left side of a balance sheet, we have current assets, and then we have fixed assets. Those added together would be total assets. So the right side of the balance sheet is the sources of funds. So we have liabilities, the current liabilities, long-term debt, and then shareholder equity. So go down on the asset side. So the first question: what long-term assets should the firm invest? And these assets need to be productive. One of the worst things a firm can do is to invest its capital in unproductive assets. These will, if an asset doesn't achieve the firm's cost of capital, they will actually reduce the value of the firm. The firm would be better off paying that money out as dividends than it would be investing in that project. Then secondly, where should I raise that money? The current liabilities would include borrowing from the money market. A lot of firms these days they'll fund long-term projects through commercial paper and then take it out as long-term debt when the project's completed. The next being long-term debt, and then shareholder equity. Typically, equity is the first form of capital, and then debt comes after that. And then So, and then finally, the working capital question: how should the operating cash flows of the firm be managed? So, so, so financial manager, what should the financial manager's primary goal to be? So, to increase the value of the firm by selecting value creating projects, making smart finance decisions, choosing the right sources for where to get those funds. This slide shows an organizational chart. The the board of directors, the chairman and or the chairman of the board or CEO, chief executive officer, and then vice president and CFO. The CFO is going to oversee both the treasurer and the controller. And the treasurer is going to oversee how money is used and how money is invested. So we have the cash manager, the credit manager, the capital expenditures, financial planning. So this is how money is used and invested. And the controller is going to deal with the taxes and then the accounting aspects. So they'll deal with the cost accounting, financial accounting. Then also deal with the information systems. Information systems has become a very big part of the accounting process for a firm. So corporate firm. So corporate form of business is a standard method for solving problems encountered in raising large amounts of cash or capital. Their business can take other forms. There are three forms of business organizations. First being sole proprietorship. So sole proprietorship has one owner. It's typically operated and managed by that one person. There are some significant difficulties that go along with that. Probably the biggest being unlimited liability. Secondly, is a partnership, and so a partnership is broken up between typically between general and limited partners. In this case, general partners would have the same unlimited liability as a sole proprietor in most cases. Limited partners are referred to as such because they have limited liability. And then finally, the corporation. So the next lecture we'll start with a comparison between partnerships and corporations.